Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. It is Friday morning. Friday snuck up on me, Steve. I didn't. I woke
I
up.
I
I
know,
thought it
right?
was like
Seven
Wednesday.
days into 2022 already. I mean, we literally blinked an eye, and it was 7 days later. I feel like Rumpelstiltskin, like I just fell asleep and woke up, and it was like, yeah, it was just yeah, a short
Yeah,
week. Yeah.
51 weeks left in the year. Not that I'm counting.
Oh my goodness, this is man. I mean, there's some truth to that. As you get older, things just go by so much faster, especially time. So,
Yeah, it's
man,
crazy.
one week already. Anyway, go ahead.
Well, what I wanted to talk about here is, again, one of the things I love about our weekly conversations is we both share with what we're doing. And one thing
Right.
that we did, I don't know, maybe it was 90 days ago or so, is we
Mhm.
we refied some debt. We took
Right.
equity out because we
Mhm.
we we thought rates were rising, right? We communicated, we shared, and lo and behold, look what's
There it
happening now.
is.
It's kind of a,
Right.
it's happening, and I think it's going to happen faster, right? Again, we got the jobs number today. Inflation is hot, wages, rents, all these things are up and crazy. So I think it's going to get worse before it gets better. But generally
Agreed.
speaking, the Fed's not going to be raising rates, but probably worst case till March. So there is a
Right.
little window. But boy, if you were, again, you've already missed the bottom. You've already
Yes.
missed at least the short-term bottom. But yeah,
Right.
it's I don't think it's going to get better. And I'm guessing the non-QM space does all of this. But before we get into that, I forgot the marketing spiel. Why don't you do that first?
That's okay. All your information was pretty much, relevant, common sense stuff, current events. You can just kind of pull it up. But long story short, I work happily for Velocity Mortgage Capital. All the ideas and topics discussed on this channel are that of my own. So let's get it going.
Yeah. So where I was going with this and why I let you do that first is I'm guessing in the non-QM space, if the Fed raises rates, the 10-year goes up and the banks
Mhm.
start raising rates and owner ocks are
Mhm.
now 4 instead of 2.5. I'm
Right.
guessing the non-QM space is going to be more expensive, right? You have your own margins that you have to manage and they're going to
I
go
mean,
up.
at some point, it's going to start to trickle down because Wall
Yeah.
Street is really the metric here because
Mhm.
it's what they feel like to some degree as far as
Sure.
what their margins are. So I would imagine it's going to get. I mean, we've gone up a little bit ourselves just to
Sure.
kind of. I didn't know what was allowed. I guess that we could kind of
Yeah,
disclose. But yeah, everybody's rates gone up a little bit.
of course.
So have ours just kind of again hedge the market a little bit, but not to the just I would say drastic volatile moves that the A paper or conventional loan market could be where
Yeah, I
in
mean,
certain
conventional paper,
rates
just
go
so
up and
you know.
down.
Yeah, conventional paper, just so you know, Matt, the mortgage guy, called me the other day and he was pricing stuff out on I think it was a duplex.
Right.
Again, right credit score, good income, good down, up a quarter
Sure.
in like 2
Wow.
days.
Right.
Yeah. So what I wanted to talk about here was a couple of things, because again, if rates are going higher, there's two things you should do. One is if you were looking to extract equity, like again, we shared,
Right.
what are you doing? Get going. Because
Right.
because it's only going to get more expensive. And
It
then
is.
the other thing is people are doing deals, right? And not all
Mhm.
lenders can lock, right? That's one thing
Nope.
that you'll see in A paper is they lock, or you can buy locks and all of that. Non-QM
Correct.
space, hard money. Again, I've done these deals. None of the people I've worked with will allow you to do rate locks, right? And
Correct.
generally speaking, over a 3-week period, it doesn't move all
Mhm.
that much
No.
because it's not tied to the 10-year. But
Correct.
if the 10-year goes wacky and the Fed
Yes.
does an aggressive move, you can get caught, right? Rates can move. There's no lock.
Nope. No
So,
ifs, ands, or buts. Correct.
no, yeah. So what I'm telling investors they should be thinking about, right? Especially if you're doing big deals, right? You're
Mhm.
doing commercial, right? You're going for fixed 30-year debt that you provide that banks don't.
Right.
At some point, you are going to have to get a better price, right? That people. I mean, again, I've been doing this a long time, right? So rates are going to be going up,
Mhm.
right? In the beginning, you can either put in more cash, so it
Right.
lowers your return on capital. But at some
Right.
point, you're going to go back to the seller and say, "Hey, I can't buy it for that because the cost of
Right.
capital is up." So again, as you were going through this, maybe it's 6 months, maybe it's a year from now. I think investors in big deals need to change their investment criteria, because I think cap rates will need to change. I think there's again, if your mortgage changes, you either need more equity or the seller has to take a lower price. So I talked with Jonathan Twombly the other day, and yeah, I mean, it's
Right.
as debt becomes more expensive, that's one of the tools in the chamber. So what do you think of that?
Well, I mean, again, it's just affordability and or cap, like you said. So
Yeah.
if the cost of borrowing that money is going to go up, then yeah, the price either has to come down or the investor just has to take a smaller margin, and I don't think that's going to happen. So
No.
yeah, it's usually the other part that the
Yeah,
price half. So
Yeah, the other thing I would tell investors to do, because again, I'm really afraid of people participating in syndications today. Again, that's a broad
right,
statement. Not all of them
right,
are bad, but
right.
a majority of them aren't great. Watch those debt assumptions,
Mhm.
because a lot of this, again, I shared a 10 unit building that I've owned for a decade. I did the actuals yesterday. But how that story started, Steve, is the building in, let's see, what was it? 2006 was
Right,
bought for 65K a door, 650 grand. You don't have
right.
any
I think you told
context.
me about that.
Yeah, you
Yeah,
don't, all these things, right? What happened is in 2006, it was the last peak of the market.
right.
That was rich.
No,
And
no, that's when I bought.
yeah, yeah, yeah. So yeah,
I know.
so this person, and it was a C class. It's always been a C class building. It's
Right.
just always have been. So somebody paid top of market, and
Mhm.
then the business cycle came in and did what the business cycle did, and
Right,
that person couldn't manage the building, but because of the debt structure, they were able to limp along
right,
until the refi period. The refi period comes, they come in and evaluate this asset, which was performing. Now,
right,
3 years later, it's got, drug dealers or whatever's in there, half are vacant,
right,
destroyed. They're like, oh, we can't refi it, or if we're going to refi it, we're going to give you this value. You got to cut a check. The lady lost the building.
right.
So we picked it up for nothing. It was a horrible couple of years to manage. I've given you the numbers. I think we spent $80,000 remodeling it over the course of 18 months. But now it's a great properties. But the story here is you can go wrong buying big. I hate bigger is better. I hate bigger is better because it's not always true. It's true sometimes, and you can get burned buying bigger. So you're muted, buddy. There he is. Can you hear me?
Yes, I can hear you now. Sorry about that.
Yeah.
Something happened with the audio. I couldn't hear you for a little bit.
Yeah. So what I was
think
just
we
saying,
talked about it before. Yeah.
yeah, what I was just saying is people that preach bigger is better don't
Right.
realize that you could really injure yourself buying a bigger apartment. And yeah.
Oh, well, I mean, most people talk about the upside, not so much the downside, because
Yeah.
I think human nature is just like, we're not really built to really look all the way around the corner, just a little bit down the street. But so big picture is just harder perspective because you see so much instant gratification. And that's what we kind of
Yeah.
live towards, like, oh, click, 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 swipe, making money now, but we'll deal with the future later, kind of thing. So, but no, it's always easier to get in than to get out. So you always kind of want to have that like exit strategy to some extent, just in case, and look at
Yeah.
all the perspectives. But yeah, no, bigger is not always better. Just bigger.
It's just bigger, exactly. And you can go broke with bigger. So again, what I would tell folks to do, I just think the deal evaluation is changing right now, right? What the
Right.
Fed communicated on Wednesday with their Fed meeting minutes tells everyone who's paying attention, money's going to get more
Yep.
expensive, and money's
Yep.
going to get more expensive relatively quickly.
Right.
And if you're getting into a deal that has a 3 or 5 or 7 year horizon,
Mhm.
don't assume it was yesterday. The debt structure is going to change. You're refi, you're out. Don't get bridge debt that's 12 months. And I'm just nervous for people that are not, you have to change your assumptions today because debt
Right.
structure will be different.
Well, because I think you were able to play a little bit more of an aggressive game as far as short-term financing initially, just because rates were so low for a while. So that whole, perspective or strategy of, historically people are only owning their loans for 3 to 7 years and da 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 da. And that's probably over the previous maybe 10 to 20 years. But prior to that, people are stuck in the long-term 30-year fix unless, refinances and things of that nature. But yeah, they didn't have the luxury of like historical low rates where you could jump around. You're in the 3s, you're in the 4s. You're still, you know what I mean?
Yeah. I mean, let's just be clear, right? You bought a house in Texas. What, if you don't mind, what is the rate on your 30-year?
Under 3%. It's like 2.
Yeah. Let's just call it 2 3/4.
Okay.
All right. Let's fast forward. Let's presume it's 5 years from now, 7 years from now, you're a big VP, you're a big shot. You want to buy a bigger Texas house. I'm just playing, right?
Right.
So you go out and now you look at a bigger house and it's, I don't know, it's Texas. So it's 150 grand more. but it's swanky. It's swanky, man. It's awesome.
Right.
And
right,
then what
right,
happens? You go and look, and now with 30-year mortgage rates, 5% versus
right,
2 3/4. So not
right.
only do you have the extra 150 grand, but now you have
Mhm.
rate shock of
Right.
2 1/4 or whatever it is across the whole loan.
Right.
Lots of people are going to shop for a bigger home, get
Right.
a slap across the face with a payment, and you're going to be the swanky executive going, you know what? I'm going to stay where I am, but I'm going to put a Mac Daddy pool in the backyard. That's what's
Right.
going to
Right. Right.
happen.
Right. Right. No, I'm
So,
well now watching this channel. Actually, I diversify that money and probably buy more rental property to have passive income
there you
because
go.
I'm all of like 5'6", 130 pounds with my clothes wet. I don't need a bigger house. You know what I mean? I'm good with that. If we're really playing, but I'm just being honest. So
Yeah.
I'm using my money to buy rental property. That's the focus. That's 2022 is at least 2 properties. That's my goal. At least 2 properties. 2022, 2. So that's the name of the game.
Very cool, man.
But yeah, no, that's good to dream. But again, my perspective is a little different now. I used to be that guy though. Yeah, my next big house and pool, because that was me 100%. But ever since this channel, man, so this is why I really love this channel. But anyway,
Awesome,
I digress.
That's all right. Well, how can people find you if they want to get some money out of, get dead money out, which I did, and we told them we were doing 6 months ago.
Yeah.
Or if they were looking at a big deal and they need some non-QM money, what do you want them to do?
SDAO, just like many people have been doing and continue to do, we're doing exactly what you're talking about, pulling out dead money. A lot of people that have the same understanding and are paying attention and are really doing the work.
Yeah.
Because the ones that are pulling out that dead money, they're finding opportunity. That's why they're pulling out that money. They're not just pulling out just to buy, mess around with. They're utilizing that money to then flip into something else that's earning them passive income. It's just not sitting there and claiming, oh, look how rich I am, but you're just hanging on to that for as long as you can until you die, but you're not having any kind of surplus on top of that to some degree, unless you're just waiting for it to, appreciate, or you could use that slower ride. But now a lot of these more savvier borrowers are tapping into that and they're finding some great deals. I mean, there's some motivated buyers out there now, because I think some of the pressure with the market are having some of the sellers think the same thing. Hey, I don't want to time it out. If I was thinking about getting out, I should get out now. Or some people can still afford it, and or whatever the case may be, and prices and things of that nature. So we're seeing an uptick. I mean, last month we did a new record month for the company. And I would say the number, but again, since we're publicly traded, I don't like to, just in case.
No, it's fine. Yeah.
But it was a large number. Company, like the company's history since 2004, the most we've ever done. You know what I mean? And I believe even with a tighter sales staff, because it's a long story, but we're running lean and mean, but we're just crushing it right now. So there's lots of great deals out there. I mean, I see it every day. Yeah. I'm getting bombarded every single day. So
very cool.
But yeah, SDAO, DAO. At velocitymortgage.com. Please put in this subject line ORAAT. Otherwise, you're going to get stuck in the quarantine because our firewall sales set so high. Please, at least if you have some sort of possible scenario, put the basic information in this body of the email as far as property type, loan amount, desired LTV, your mid FICO score, possibly address if you have that, and then best phone number to reach you back at. And I'll try to call you back today. I apologize for last week. COVID and the flu just decimated my support staff. So it was just couldn't get back to people in time, man. So that, other than that, please, I'm working this weekend, so trying to get caught up. Got a ton of energy ready to go. We want to kick off 2022. As you can tell, no coffee, Mike. No coffee.
That's nuts. That's nuts.
I know.
Thanks, buddy.
I know. Thanks, man.